return on investment is a widely used financial metric that measures the profitability of an investment in a certain period of time. That time could be monthly, quarterly, usually, or annually. The way this metric is calculated is by dividing the pre-tax profit of an investment by the cost of that investment. Suppose we have a stock which pays no dividend that we purchased for $1,000, and in a year's time it trades for 1,200. Since you don't have dividends, the capital gains is equal to the total profit, which is $200. So we divided $200 by the 1,000 that we paid a year ago to buy the stock, and we have 0.2 or 20% return on investment. It's very important, very important to bear in mind and understand that the risk-adjusted return on investment is a more important, much more important metric than the return on investment, because risk is a crucial factor that should be taken when we qualify an investment, when we decide to invest in an instrument, whether it's a stock, a bond, real estate, a business, or anything else. Risk is usually measured by the volatility of returns. And for example, in the case I mentioned before, we spent 1,000 to buy stock, and at the end of the year, the stock it was 1,200. But in the third month since we purchased the stock, the value of the stock it went down to 800. In the 6th month, it was up to 1,150. In the 9th month that we held the stock, it went down to 800. And finally, at the end of the year, it reached 1,200. On the other hand, we could have a similar stock or dissimilar, another stock anyway, which produced a 20% return, a stock that we purchased for 1,000, but it never went below, let's say, 950 or 1,000 since the time we purchased it. So in this case, the risk we assumed by purchasing the second stock is much lower than the risk we assumed by purchasing the first stock in our example. Risk-adjusted return, it means profit per unit of risk assumed, we could say so. So if we produce the same profit by assuming less risk, is a better investment than the one that needed the assumption of more risk to achieve the same results. There are some metrics, some ratios that we are using in this business to measure risk, based basically on volatility, which volatility is measured in statistics by a metric called standard deviation. And these metrics, the most widely known is Sharpe ratio, which measures the excess return per unit. is the Sortino ratio, which it measures the excess return per unit of downside risk only. It doesn't take into account the upside volatility. Is the beta, the so-called beta, which measures the sensitivity of returns of a stock to the market return, to the total market return. The Treynor ratio, which measures the excess return per unit of beta of systematic risks, and some other ratios that we don't need to talk about right now. But I'll make a video soon to explain these important metrics and the crucial role of risk measuring and calculation in investment decision making. It's very, very, very important because many people they look only at the non-risk adjusted returns, which really, if you think about it, it makes not much sense. So risk is always important. Again, risk on investment to recapitalize is the gross, the pre-tax profit an investment produced in a certain period of time divided by the cost to acquire, to purchase that investment. And again, when most of people are talking about ROI, return on investment, are not talking about risk-adjusted return on investment, which is I mentioned many times in this little video. It's very, very important. Again, I'll make a little video sometime soon to explain the role of volatility and risk calculation in investment decision-making process. Stay tuned.